Market crashes tend to feel sudden, but they're almost never surprising. They follow a pattern, not once, but every single time. In 2008, it felt like the system collapsed overnight.
Let's talk about the speed with which we are watching this market deteriorate.
Traders here working the phone say a lot of their customers are freaked out, waiting to see how low the Dow will go.
It was the worst day on Wall Street since the crash of 1987.
Housing prices fell 40% in some cities. Entire neighborhoods went dark. Lehman Brothers, a 158-year-old institution, vanished in a weekend. In 1929, the market dropped 89%. 1 in 4 Americans lost their job. Families went from champagne to soup lines in 30 days. But these weren't freak accidents. They were the logical outcome of behaviors that always repeat themselves. And they're repeating themselves right now. Today, I will show you the 4 signs that always appear before a crash and what smart investors do while everyone else is asleep. Let's go back to 1634. This is before Wall Street, before electricity, and even before the word bubble existed. Well, at least in this context. This was the Dutch Golden Age. They invented the stock market, and within years, they invented the crash, the asset, tulips. They were beautiful, rare, and a status symbol. Think of a Rolex, but for your garden. Some tulips sold for 5 times the annual average salary at that time. That's like paying $200,000 for flowers. This wasn't investing, this was flipping, and a bit of euphoria. The first universal warning sign is investors become way too overconfident. As prices rose, the Dutch invented future contracts so you could lock in the next season tulips at today's price and flip the contract itself. Soon people were trading the paper and not the petals. Prices kept raising, and the logic became,
even if the price drops, I can grow more tulips later.
Doesn't that sound a little bit familiar? Remember NFTs, tech stocks in 2021, crypto platforms with 20x leverage? This is called the euphoria stage, when valuations stop mattering. Everyone believes they can sell it to someone else, and that's just betting the next person is dumber than you. Here's the psychology behind it. Our brains are wired for short-term rewards, which causes dopamine spikes with every single gain. So we chase certainty in a system that punishes certainty. And when belief breaks, so does the market. There was a Dutch quote that came out during this bubble pop, and it was, "Many a plowman has high hopes, but all he reaps is stubble." Now, the next stop in the 4 stages of recognizing a crash is realizing the regulatory frameworks are just not in place for the mania that's going on in a specific market. Let's use 1929 as an example. The roaring 20s, the market was soaring, leverage was everywhere, and the government's motto was really simple. The business of America is the business of America. And that is the second warning sign in action. It's regulatory failures. In 1929, regulators did nothing at all. New products like leveraged investment trusts let people borrow on top of borrowed money, and Wall Street loved it. But also, so did the everyday investor. One little girl from Kansas even mailed $4 to a Standard Oil stock. By the time it arrived, it went down 15%. It dropped another 10% the next day. If that doesn't highlight regulatory failures, then I don't know what would. Shoe shiners gave stock tips, and newspaper headlines were, "We've entered a new era, no more boom and busts." And then it busted. The market dropped 89%, and we entered the Great Depression. Now onto the third sign of a crash: innovation that nobody actually understands. Let's use 1987. Wall Street's golden age of greed. Computers were new, and traders were rock stars. And the banks rolled out their latest product, portfolio insurance. It was based on Nobel level math. Supposedly, it would automatically protect portfolios during a downturn, which sounds brilliant until everyone uses it at once. Stocks dropped, computers started selling. That selling triggered more selling, which triggered a panic. This is the third warning sign: a new financial innovation that no one fully understands, not even the creators. By 1987, over 80 billion was being ran through these portfolio models, and no one realized what would happen when the models turned at the same time. Then came Black Monday. On October 19th, 1987, the Dow fell 22% in a single day, the worst in US history. And it wasn't just the tech, markets were already frothy. In fact, that same year, a man from Cincinnati faked a $6.8 billion takeover. The target stock 7 times overnight before crashing. This was the moment the investors realized it was a lie. When markets stop asking questions, they start writing eulogies. And onto the fourth and last pattern: that you will always see inside of crashes. This is excessive debt. Now let's talk about '08, one of the most memorable moments for all of us probably watching this at this moment, the one that made Wall Street feel personal. After the dot-com burst, investors wanted safety, and housing felt perfect, so the banks got creative and did mortgage-backed securities, CDOs. Basically, they packaged toxic debt as AAA safety and sold it globally. This is the fourth and final pattern: excessive debt, which is often buried under complexity. For homeowners to hedge funds, everyone was using borrowed money to chase returns. And when it unwound, it took everything down. Lehman Brothers, 150 years old, gone in 72 hours. The stock market collapsed and jobs vanished. Entire neighborhoods were emptied out. If you'd lived through it, you'd remember. It didn't just break banks, it broke people. So the best thing that we could do is make sure that we're spotting these signs so that way we know where we're at in the cycle, because crashes don't copy and paste, but they do rhyme. And if you're still watching, you're already ahead of most investors. Most people don't study patterns until they've lost everything. I myself am victim to this as well. So ask yourself, are you investing based off of what people value or vibes? Are regulators ignoring fast-growing markets? And are we relying on innovation that feels magical, but no one can fully explain it? And the last thing, is the debt cheap? Is it easy to get, and is it everywhere? If the answer is yes, then you know where we're at in the setup. This is what the smart money actually does during this time. I spent a lot of time with one of the greatest investors, Robert Kiyosaki, the author of Rich Dad, Poor Dad, and one of the things he really drilled into my head was cash flow. All the money I had was in markets. He told me it's a waste of time. I need to focus on my business and increase my cash flow because the amount that I had invested was not going to make me a multimillionaire. And if you have cash coming in, then chances are when these investments or potential assets do crash and most of the people get shaken out of their positions, you now have the ability to buy up these assets at a major discount. You never want to try and time the bottom, nor do you want to try and time the top. A better alternative to that is dollar cost averaging into the positions that you are in for long term. Allocating your buys into different assets at different price points can give you a massive edge amongst the majority of people. While crashes can seem scary and it may feel like the end of the world, there will always be markets and people will always be getting involved. And when that happens, these cycles will repeat themselves. Overconfidence, regulatory failure, misunderstood innovation, excessive debt. Now the question is, where are we in this cycle? With asset prices continuously pushing to new highs and everyone making money no matter where they buy, and a large portion of people taking on massive amounts of debt to acquire certain assets. Comment below, where do you think we are in the cycle? And if you want to stay up to date with financial tips, you'll subscribe to this channel so you don't miss out on the next one. Thanks for watching.